From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Friday, December the 17th, we're 30 minutes into U.S. trading. What do you need to know? Let me lay out the top stories for you that we're going to be following this hour. Stocks, well, the post-Fed hangover continues into Friday. Also expect a bumpy ride as we work our way through over the next few hours, triple witching. Data out of South Africa today showing a much lower rate of hospitalizations. Omicron sweeping rapidly across that country and now much of the rest of the world. Rivian tumbling as well. It's told investors that it's going to miss production targets. We're going to be speaking to GM's chair, Mark Reuss, his company delivering its first all-electric Hummer today. We also need to talk about why the stock is a little lower. The CEO of Cruise, the autonomous driving unit, departing, a surprise departure. We'll talk to Mark about the details surrounding that. From London, I'm Guy Johnson, my co-host in New York today, Sonali Basak. Alix Steel off today, doing a bit of pre-Christmas baking. Welcome, everybody, to Bloomberg Markets. Sonali, we need to talk about our question of the day. We need to talk about what's happening with these markets. What has changed this week? And you made this point in our morning meeting this morning. How fragile are these markets? Let's bring in our good friend and colleague, Romain Bostic, Bloomberg Markets co-host, to give us his take on all of this. Romain, it's been an incredibly bumpy week. We're still trying to figure out what it all means. The dust, I don't think, is completely settled. What changed for you this week?
I think what changed here is the tone of what we got out of the Fed. Remember, this was a real shift in focus, a focus that for most of this year was focused on maximum employment. And what we heard out of Jay Powell earlier this week, as well as on that testimony back on November 29th, was that the focus is now firmly on inflation. And more importantly, Guy, on a lot of the data that we're starting to see, that a lot of purchasing decisions by consumers and by businesses are now starting to be altered by the pace of inflation. That's what the Fed's worried about. And it appears that's now what the market is worried about as well.
Yeah, speaking of the market, you're better at this than anybody. What does a 1% decline in the S&P really mean?
Well, it doesn't mean much when you consider the record high that we're at. But, I mean, look at where we are. You go back a year, almost a year today. You know, we do these surveys here at Bloomberg where we poll all the strategists. We say, where do you think the S&P is going to be at the end of the year? We did this in December of last year. What was the median, the average, I should say, estimate? What do you think it was to end 2021?
43?
4,000.
Okay.
Yeah, we passed that,
Wow.
I think, on April 1st. And even the highest estimate in that survey was 4,400, which we passed back in July. So we're well above everyone's expectations at the end of last year of where we would be at the end of this year. So when you look at a 1% drawdown here, Sonali and Guy, and you put that in a context of where folks expected us to be at the end of the year, we're still sitting in a pretty good place here. And I don't think you see panic on the street, but you certainly see some repositioning.
Sonali, you talk to a lot of bankers. What are they telling you right now? This has been an incredible run this year. The market has got tighter and tighter as well. Big tech absolutely dominating. What are they telling you? What is the tone that you're getting from people right now on Wall Street?
You know, it's interesting. It's that we're going to head into a fine place, but not a great place, that everyone should expect to be making less money next year than they did this year. But with that said, they're looking for investors who are willing to invest for the long term and ride out the volatility into next year, Guy. I'll steal a line here from Josh Wolf at Lux Capital, where he thinks this to-the-moon rally just cannot continue. Romain, you know, this to the moon idea, what happens to these to the moon stuff?
Well, let's talk about to the moon. I don't know if we have the data here. I see this big chart. This is a great studio you guys got over here, by the way. We should get this for our set. But, I mean, you talk about some of the high flyers. You talk about the ARK Innovation ETF. That was, of course, the big winner last year, and it's down pretty significantly this year. But when you look at what we've seen just over the past couple of months, ARK Innovation down something like 20%. The Renaissance IPO ETF, which tracks IPOs, which, again, the bloom has come off the rose of that. That's down something like 17, 18%. And then, of course, we all know what's happened to crypto here over the last couple of weeks. So the riskiest assets out there are starting to see a little bit more of a breakdown. And I think you're starting to see panic there because there's no real footing there, right? But then when you look, Guy and Sonali, at a Microsoft or an Apple or even a Tesla here, there are fundamentals that underpin those companies and to a certain extent underpin the rise that we've seen in those stocks.
But those are the stocks that are underpinning these markets.
Yes.
Those are the stocks that are underpinning the S&P. It's big tech. That's where all the weight is right now. If big tech has a problem, this market is looking very, very vulnerable. And this market has got narrower and narrower. We've seen this kind of ongoing rotation. And as we've seen those rotations throughout the year, money has become more and more concentrated in big tech.
And exactly to your point, let's look at software stocks, for example. This is another example. Something that kind of flew under the radar yesterday, about 24 hours ago, was this big earnings warning that we got out of Adobe here. And this is kind of what we're talking about. These stocks made up a big portion of the gains that we saw earlier this year. These are also stocks that have some of the highest multiples in any of the indices. Pick any indice here in the U.S., and the biggest multiples tend to be baked into a lot of these names here. So when you start to hear those companies talk about a slowdown in their growth rate, whether it's on revenue margins or on EPS here, that causes a lot of concern. So you saw a huge sell-off in the software stocks this week. In fact, that's going to be one of the biggest underperformers here, not only this week, but probably for the month of December.
Sonali, equity vol tends to follow credit vol. The credit market has had a great run. I know it's going to be a little bit cautious into probably year end, but there's a lot of things lined up for the beginning of the next year, I hear. What do you hear about the credit market going into next year? What do you hear about what the story is? Companies have really taken on a lot of debt. Are they going to continue to do that? How much risk is there?
Incredible. There's two things going on at the same time where leveraged finance markets have jumped back to records, and private equity is sitting on so much dry powder that they're willing to still do deals, propping that market even higher. But then you look at Citigroup's call, Guy, the idea that $70 billion worth of high-grade bonds can face downgrades into next year as the economy slows, as rates rise, then you've got to wonder about investor risk appetite when it comes to taking risk in corporate bond markets, especially when you look over that long term when some of these companies just may not make it through.
Yeah, I think that's going to be, it's going to be interesting to see which is the lead asset class as we work our way through these rate hikes. How are we going to see credit, the bond market? The bond market is signaling basically at the moment that the Fed is going to be making a mistake. The credit market looks a lot more sanguine still at this point. But if you take a look at the yield curve, the message is pretty clear. And I know Jay Powell tried to downplay this in the press conference, but the message at the moment is, are we setting ourselves up for a policy mistake?
That's the big question here. I mean, you get a lot of different opinions depending on who you talk to. But when you look at the price action in the bond market, it seems to suggest that not everyone is really on the same page with the Fed right now, whether it's with regards to the end of the taper, the start of those rate hikes, or the number of hikes. I mean, we had Richard Saperstein of Treasury Partners on yesterday on Bloomberg Markets to Close. He's actually in the thinking right now that we may not actually see any hikes next year, despite the fact that you're already, getting this this guidance of about 3 hikes in 2022. Now, he seems to be a little bit more on the extreme in terms of his predictions, but you are hearing other folks saying that 3 hikes probably isn't going to happen. You're probably going to get 1, maybe 2, but considering where the economy is going, 3 may actually be a little bit of a stretch here. And can I just turn the tables on you for 1 second, Guy? Because, another point that was brought up here was the underperformance of a lot of the European assets relative to the U.S., the underperformance of a lot of global assets relative to the U.S. And the big question a lot of people are starting to ask is, when do you see that catch up, if at all?
Well, if you think about it, if you do see the reflation trade coming back, the value trade is going to be really interesting. Europe, in many ways, is geared to that cyclicality. The other factor as well, Romain, in all of this is what's been happening with the dollar. The dollar has been strong. Let me just kind of bring up my WEI screen because I can give you the evidence behind this. If you're a U.S. investor, let me flip this round so I can talk about it from a dollar point of view. If you are a dollar investor investing in Europe this year, let's take the Euro Stoxx 50 as an example. If you're a euro investor in the Euro Stoxx 50 this year, you've made 16%. If you're a dollar investor, you've made 8%. The currency has really hurt this year if you're a US investor. And I think that's kept money at home, and it's the exact opposite for European investors investing in the US. So money has just been pouring in your direction.
Yeah, that's a fantastic point. And I mean, we talk about some of the dollar strength that we saw this year. Again, going back to where we were last year when people were making predictions, you really didn't hear anyone talking about an up year for the dollar.
Guys, we have to leave that there. Are the markets more fragile? We'll be asking that question all day. Thanks to Bloomberg's Romain Bostick. This is Bloomberg.
It's time now for the Bloomberg Business Flash to look at some of the biggest business news stories in the news right now. I'm Angel Feliciano. U.S. regulators have fined J.P. Morgan $200 million for breaking rules involving employee communications. Bank executives were supposed to make sure that workers' messages were archived for regulatory scrutiny. But even the bosses shrugged off the rules they were supposed to enforce by using platforms such as WhatsApp or personal email addresses for business messages. Amazon's customers in the UK will now be able to pay in monthly installments. That's a result of a new tie-up between the online retailer and Barclays. Purchases of $133 or more on Amazon will be eligible for the new flexible payment method. Buyers will be able to spread out the cost from between 3 months to 4 years. And shares of Rivian Automotive are tumbling after its first earnings report as a public company. The electric pickup maker said it expects to fall short of its annual production target. The EV startup will be a few hundred vehicles short of its goal to produce 1,200 units by the end of the year. And that's your Bloomberg Business Flash. Shanali, Guy?
Angel, great stuff. Thank you very much indeed. Actually, I want to pick up on that Rivian story. The Rivian slump is continuing. I think we're down now, circa 15% on the stock. I think that's the lowest as well, Shanali, since the IPO. It's certainly turning out, there we go, we're 18%, that's a two-day chart, but we're off by 18% over the last couple of days. They're only talking about missing by a few hundred vehicles, but they're not producing that many vehicles, so that sounds like a big chunk of change.
Yeah.
It looks as if they're focusing on the Amazon story.
Yeah, a few hundred vehicles out of 1,200 vehicles, Guy, that's 25% potentially of the vehicles they were supposed to make. Indeed, that's right, they are trading the lowest since the IPO, and you've got to wonder where those patient investors are when it comes to those near-term hiccups that the analysts are saying that are inevitable.
Yeah, and that's the point, isn't it? That this is going to be something that all of these new startup companies are going to have to deal with. And Rivian has got a lot of things on its plate right now. It's trying to make these vehicles for Amazon. Amazon has obviously backed the business, trying to get everything lined up in a world where you're dealing with labor, where you're dealing with chip shortages, when you're dealing with trying to figure out how to make cars, mass-produce cars. Super tricky for the super tricky. We spent a long time following Tesla. Every time it had a production update, it has turned out to be a company that can deliver, but it's a huge challenge. The engineering around this is hugely complicated.
Inputs won't be cheaper. And guess what, Guy? The cost of capital also won't be cheaper to finance these projects moving forward. So bumpier road ahead.
Yeah, can they all survive? Are all of these car companies going to survive? Are all these startups, the IPOs, going to be around? Is the pie going to be big enough? Or actually, in reality, are we throwing a lot of stuff at a wall and then we'll see exactly what sticks? Clearly, the original OEMs, the ICE OEMs, the car makers like GM, Volkswagen, Ford, etc., are going to have something to say about this as well. We're going to catch up a little bit later in this hour with one of them, Mark Royce, General Motors president. He's going to be talking about GMC's new Hummer EV. We'll also get his take on Dan Ammann departing from Cruise, which is their autonomous driving unit. That's what seems to be driving the stock lower today. We'll talk about that with Mark, get his take on what exactly the message should be. Let's get back to the markets. Let's talk about what we've got coming up for you. BlackRock's head of iShares Investment Strategy Americas is going to be joining us, Gargi Chowdhury. Coming up next, how fragile are these markets? That's the question we're trying to figure out today. We'll talk to her next. This is Bloomberg. "48 minutes into U.S. trading. Let's get back to our question of the day. What has changed this week and how fragile is this market? Let's bring into the conversation Gargi Chowdhury, BlackRock head of iShares Investment Strategy Americas. Gargi, let's kick it around. We've clearly got a kind of post-Fed hangover that we're still dealing with this Friday. How fragile do these markets feel to you?
Sure, Guy. Good to be here again. These markets feel very fragile today, but I'm going to say that it doesn't actually have much to do with the Fed or the message from the Fed on Wednesday. It's much more around fears around the virus and how that might look over the next 2 to 3 weeks, especially here in the U.S. So it's, I think the Fed's message was clear. It was one around the economy needing to remove accommodation because of the strength in growth, the labor market, and inflation reaching target. But I think the market is feeling fragile because we're looking at some higher numbers today than we did just 2 weeks ago, and expecting them to go higher higher over the next few weeks as well, with everyone traveling for the holidays.
In some ways, it's easier to adjust to an interest rate strategy. But with the way the variant is moving and creating further work from home strategies, you see energy and financials down more than anything else today. How do you adjust your investment strategy, Gargi?
Sure, Shanali. So I'd say a couple of things. First of all, let's hope that we're all wrong about the efficacy and the transmissibility of the virus, and more so the severity. And even if that does pick up over the next few weeks, especially amid the year-end illiquidity, if it does create some volatility, I think we have to look within our portfolios into 2022 on what might be driving the markets outside of the Omicron variant, and what might some of those be. So number one, we already heard from the Fed, and we saw that they're still going to have a very muted policy path. So yes, the FOMC was considered a little bit more hawkish, but I'm going to say that looking past the 2022 three-dot surprise, we're supposed to look at the 2024 rate hike path, or the 2023 rate hike path, which again looks quite muted. And throughout this entire period, real rates remain negative. And I think that is what is going to drive equity market performance for 2022, which we still think will be positive, not as positive as this year, but we still think you're supposed to focus on that negative real rate dynamic. We're supposed to focus on the tremendous growth that we're seeing in the U.S. economy, that we're seeing in the labor market, and that is what is going to be the driver of markets after we look past this Omicron-related volatility over the next couple of weeks.
I hear what you're saying, but I look at a stock like Apple. I came in on Monday and everybody was super excited about Apple getting to $3 trillion. This week, Apple's down by 5% and has fallen quite sharply post the Fed. Gargi, this market has become very concentrated in some very big tech names. And I'm wondering, in the kind of environment going forward, whether this narrowness is going to be a risk.
I mean, look, it's certainly something that we're all paying attention to. I mean, obviously, we all know there are 5 big names that have resulted in more than 35% of the year-to-date returns. I think that, you make a good point about the technology sector. Obviously, there's been a little bit of a pullback. But if we think about right after the FOMC, press conference happened on Wednesday, actually, the tech sector traded just fine. It was much more, yesterday and today where there's been a little bit of a pressure. So yes, the breadth or the lack of breadth is something that we're going to focus on, and that can get concerning. I don't think it's something that is going to drive, that's going to be too, concerning yet, but that's something to keep our eyes on. But I still think that in the longer term, again, once this volatility has passed, what should be driving valuations? I think it should be very much around negative real rates. It should be very much about profitability of these sectors. It should be very much about how many of these companies, especially when you're looking at tech, have that pricing power. In a world where prices are going to be higher, which is our base case, a slightly higher inflationary regime, companies with better pricing power are going to continue to do well, and quality companies are going to do well. So, there are going to be idiosyncratic news around, for example, supply chain disruptions, et cetera, that could drive markets, but you're supposed to focus on the bigger picture.
I'm wondering about the more sensitive strategies. Think the Qs, for example, things that are more weighted towards the tech industry, these sectors that have performed so well in this last cycle. What becomes of them?
Well, if we remain in this muted policy path, where interest rates do move higher, as they should, because the economy does not need the same level of emergency accommodation that it did in March, April of 2020. If we still see this really muted policy path from the Fed, where they raise interest rates, but at a much slower pace than they would have in previous cycles where inflation was running much above target, I think the tech stocks, and especially sectors and companies that have better pricing power, can continue to do well. We're not looking at interest rates getting back to 3-4%. We're looking at a very small increase in interest rates. And by the way, the Fed is still providing accommodation till March. They're still buying bonds.
In terms of going into next year and thinking about how I need to be positioned, how much volatility should I expect? And is passive the place to be if volatility is going to rise?
Sure. I mean, look, just because you're looking at an index and allocating to that index doesn't mean you're passively allocating money. We believe that every investment can be an active investment. And with ETFs and iShares, given the bespoke nature of the offerings that we provide, you can get very targeted exposure. So one of the areas of the market that we've been talking about is really looking at semiconductor stocks, for example. That's a sector that we think is going to have high operating margins. And you can get that exposure within ETFs, within a very targeted type of ETFs. So yes, volatility can certainly rise, and we're seeing that. But that doesn't mean that you have to abandon index approaches. And of course, we're BlackRock, so there are very good active approaches as well that you can allocate to.
Gargi, thank you so much for joining us. That's Gargi Chowdhury, BlackRock's head of iShares investment strategy in the Americas. Thank you so much. Coming up, we'll discuss how Omicron is shifting the return to office landscape. We'll have the head of the Partnership for New York City joining us next. This is Bloomberg.
So we're an hour into trading on Wall Street. Let's figure out what's going on. Abigail Doolittle here with the movers. Abigail.
Well, Guy, you know, it's really another sell-off day here for stocks. We had that bit of a rally midweek on the Fed, but it's been a big reversal since then. Take a look at the S&P 500 down 1.2%. The NASDAQ 100 down about 0.9% off the lows, but on the week down more than 3.5%, is worst week, I believe, still since February 2021. The Golden Dragon China Index in particular taking it especially hard, although off of its lows too, down about 0.8%. And then really interesting, the bank index, that KBW bank index, down more than 3%. That has everything to do with the fact that yields, despite the more hawkish Fed on the week, are down. A bit of a conundrum for investors. If we take a look at a 5-day chart of this 10-year yield, we will see a pretty significant drop coming in about 11 basis points, really in contradiction to the Fed saying that they are planning on hiking probably 3 times in the coming year and reducing the taper, or doubling the taper, I should say. Nonetheless, investors at this point buying bonds. So something to think about there. Of course, that should help tech, but that's not really what's happening on the week. Apple, Microsoft, Alphabet, Tesla, big declines. And this is super interesting because you would think last year was all about the stay-at-home trade, big tech winning, the reopening trade not so much. If we go into the Bloomberg terminal, we're going to see where's an investor to hide right now. Neither. In yellow, we're looking at the reopening trade. So earlier this year, when the vaccine started to roll out, really beating the stay-at-home trade in a big way. At this point on the year, we have both the stay-at-home trade and the reopening trade down 5 and 10%, Shonali. Very difficult situation for investors. Again, not a lot of places to hide in this uncertain market environment.
Yeah, pretty amazing. There are a lot of things getting lower on the day. Bloomberg's Abigail Doolittle, thank you so much. Now, if people are staying at home, can they be trading as much? And can they be doing deals at the same rate? We have Citigroup and Jefferies telling staff to work from home. Some of this is through the holidays. It's the holidays anyways. But now what happens after the holidays? holidays. We have big tech companies putting RTO plans from home. Does this continue? We have Catherine Wild, the Partnership for New York City president and CEO, joining us. She really has a pulse of what the biggest employers in the city are doing. Catherine, you had this estimate that more than half of staff would start to come back by the end of January at the biggest employers. Does that start to look more tenuous now that we have this variant rising?
In fact, it's a lot more tenuous. You know, we came out of the lockdown for the initial COVID in June of 2020, and everybody thought we would spend the summer bringing people gradually back and that we'd be back in the office by September 2020. As we know, that didn't happen. And each setback, we thought we had the vaccine, we were going forward, we thought we were on a good track, and then the variants came in, first the Delta. We really are facing a situation where the longer this COVID goes on, the harder it's going to be to get back to what we called normal, which is the return to the office and the return to life as we knew it.
Do we want to go back to normal? Like, people talk about kind of returning to the normal of pre-pandemic. Things have changed, Catherine. Are we really going to be heading back in that direction? I hate to quote Mohammed Al-Arian here, but are we heading for a new normal? And what does that new normal look like? I've been surprised how quickly the City of London has emptied out over the last few days as people have been asked gently to return to their homes. They seem to have done it in droves.
Well, New York and London have something in common, is that our whole economy and infrastructure is built on a hub and spokes model where we've got a center city, in our case, Manhattan, which is the center of our economy, 1.2 million office workers who spin off a tremendous amount of activity, who have all been working remotely for almost 2 years, going on 2 years now. So it's not going to go back to normal, but how are we going to rebuild and rechange our economy, reinvent our economy and our infrastructure? I mean, our subways are at 43%, are down 43% from pre-pandemic, and that was in the fall. It's lower right now as we head into the holidays, I'm afraid. Tourism, we've lost completely. Our brick and mortar economy, retail, is down, all because we have a system that for the past 50, 60 years has been built around our financial services, professional services, growing technology sector, media sector, all of which now have found they can operate from anywhere in the world and keep the economy going.
Anywhere in the world, Denver, Miami, Austin, Dallas, we have so many companies that have already been finding staff elsewhere in the United States. And what kind of threat does that pose for New York City, especially as there's such a slow return back to these offices?
I think it's less a threat than a challenge, hopefully. I think New York City is up to it. I lived through the fiscal crisis, the urban crisis of the 70s, when we lost half our Fortune 500 companies. 1 million people moved out of the city, and we rebuilt. In that case, it was the financial industry that really led us into, by the 1990s, we were back. And in 2001, we elected Mike Bloomberg mayor, actually the end of 2000. So we have reinvented ourselves before. If you think about Lower Manhattan and the terrorist attacks, we reinvented that as the nation's fastest growing live-work community within a few years after it was decimated. So New York has an endless capacity to reinvent itself, but it takes money, it takes work, and it's going to take time. So in the meantime, we definitely face huge challenges.
I guess we should probably point out that Mike Bloomberg is our founder. So, yeah, we certainly look back on those times.
Forgot that. Sorry.
Of the Bloomberg era fondly. Catherine, what I've been surprised about over the last few days is how willingly people have gone back to working from home. Now, that may have something to do with the holidays. They want to protect themselves, so they make sure that they can have Christmas. Nevertheless, it doesn't seem to have been a kind of big push to get people back to working from home. How do we make cities more attractive? What do we need to do to make offices more attractive? How does this work going forward? What needs to be there for somebody sitting at home right now to go, you know what, I want to come back?
I'll tell you the truth. I'm less worried about the people who are working from home than the people who can't work from home, like our hospital workers, who are now facing another surge in hospitalizations, which is they're exhausted, they're burned out, it's very tough. And the same with our retail workers, many of whom have struggled with the ideas of vaccinations for lack of trust in the healthcare system. So yes, we've got the professional classes that are working remotely and want to continue to have that flexibility. That will probably happen. We've got the women in the workforce who have childcare and other responsibilities that it's been much easier for them with the work from home model. I mean, much harder in some ways because they've had to educate their kids at the same time when the schools were closed. So we've got all sorts of changes going on. And I think that this is something that we're going to have to focus on, but we can't focus until we know when we're going to really have a victory and have the immunity necessary in our society, the vaccinations that now Pfizer's coming out with a drug that can apparently a therapeutic against the COVID. So hopefully, if we can beat the disease, we can handle the other issues. But the uncertainty that's associated with the continuation of the COVID is making it more and more difficult to figure out what is the hybrid solution. 80% of our companies and the big companies, big employers in New York have said they're going to go to a hybrid work model after the COVID is over, a permanent hybrid work model where people work maybe 3 days, 4 days in the office, 2 or 3 days at home. That's going to happen, but it's not going to be finalized. We're not going to know how it works. We're not going to know the impact until we get through this end of this pandemic, and that's got to be our first priority.
Catherine, given how many CEOs you speak to across the city, what is the most significant change you're seeing business leaders make to face this uncertainty?
They're listening. They're listening to their people. They're communicating with their people. They're taking seriously the challenges associated with what the impact of this COVID has been on people's mental health, on their stress levels, and on their expectations of work. And every employer is focused on how am I going to make the office more attractive to people, more fun to be in, make people know that they're utilizing their time well. There's a reason to be here as part of the team. So it's a whole revolution in how they're thinking about it. And that's going on, but it's not going to get implemented until people are confident in coming back to make the commute, to come back into the office. They feel safe and secure. They know their kids are okay in school. So a whole bunch of stuff has to happen on the health side. Yep. And then I think you're going to see a real change in the nature of the workplace.
Catherine, great to see you still in the office. Thank you very much indeed for joining us today. We really appreciate it. Catherine Wild, Partnership for New York City President and CEO. Thank you very much indeed. Coming up, the prompt in front of me says revving engines, but the point here is there are no engines, just motors. GM debuting its first ever EV Hummer. There it is. The stock dropping today, though, after we saw a departure from GM's autonomous driving unit, Cruise. Dan Ammon leaving. The stock's down on the back of that. We're going to talk about the EV story. We're going to talk about the Hummer. We're going to talk about what's happening at Cruise. Mark Royce, General Motors president, is coming up next. Looking forward to that conversation. This is Bloomberg.
This is Bloomberg Markets. I'm Angel Feliciano. You're looking at a live shot of the principal room. Coming up, Adam Posen, Peterson Institute for International Economics president. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Angel Feliciano. More evidence of the Omicron variant's ability to evade vaccines. According to a study, COVID shots from Johnson & Johnson and China's Sinopharm were found to produce few or no antibodies against Omicron. The same thing goes for Russia's Sputnik vaccine. Emerging research on Omicron is prompting governments to speed up booster shot campaigns. President Biden is warning unvaccinated Americans that they face what he calls a winter of severe illness and death. The president urged initial doses and booster shots in the midst of a surge of coronavirus cases. He did say that the spread of the Omicron variant has been slowed for now. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Guy.
Much indeed. The GMC Hummer EV pickup trucks are officially rolling off assembly lines. This as General Motors continues to push into the world of EVs. The auto giant is looking to grab more market share in this ever-growing green vehicle jungle. If you're going to drive through a green jungle, maybe a Hummer is exactly the vehicle you want. The positive news, though, being a little overshadowed today, as you can see, by the departure of Dan Ammann from GM's autonomous driving arm Cruise. That, as you can see, dropping the stock by around 5%. Joining us now to discuss all of this, Mark Royce, General Motors president, and my good friend and colleague, Bloomberg's David Weston. Mark, thank you very much indeed for your time today. We greatly appreciate it. Can I just park the Hummer for a moment? But I definitely want to come back to it. The stock is down today on Dan Ammann's departure. What message would you send to investors about the changes that are happening at Cruise and the impact that they're going to have?
Well, good morning, Guy and David. Appreciate you having me on the program here today. You know, as you saw in the company statement, Dan Ammann has left Cruise. And we believe Cruise is in great hands with Kyle Vaught, who's Cruise's co-founder, president, and CTO, and he's taking on the role of interim CEO. What I really want, the investor community to know is that Cruise and GM are totally aligned on accelerating the joint autonomous vehicle strategy we outlined on our last investor day, which you would have seen. And, we are leaders in the AV technology and have a lot of growth opportunities ahead, and we intend to lead. So we are deeply committed. We've got a great team there. We've got great people all across the enterprise working very hard to integrate and accelerate Cruise. So I would leave it there. And, we are all in.
So, Mark, I know you don't want to address the question of why Dan Ammann left, but address a different question, perhaps, if you would, and that is the timing of when we're first going to see commercial application of a Cruise vehicle, because there had been predictions we'd be seeing it pretty soon, particularly in San Francisco. Are those going to be delayed?
Absolutely not. That's a great question, David, and I do want to make sure that everybody understands that, we are accelerating our effort here. We are on track plus with the deployment on a commercial basis. In fact, we are right on the doorstep, as you mentioned, of the okay from our regulators to be able to charge and have driverless vehicles for our customers. We're doing some of those rides right now, as you might have seen, with our employees and finalizing the touches on that. But there is absolutely no delay or hesitation. It's full on. Let's go, and we're all in.
So let's go back to the Hummer, if we could, that Guy parked just a moment ago or so. The Hummer, it looks like a beautiful vehicle. I've seen the prototype. It's rather expensive. It's high-end, and General Motors, led by you and Mary Barra, have really gone high-end with that. And then the Lyriq coming out, I believe, sort of toward the beginning of the second quarter. Tell us about that strategy. What about the mass market? Because one of your opponents, starting with an F, seems to be going the other way.
Well, I mean, we're talking about things like months here, not years. And so, one of our competitors and some of our competitors do not have dedicated platforms. We made these decisions to go all in 3 years ago, irregardless of what was happening either politically or in the greater environment, because of the focus on zero emissions and the planet, frankly. And so that end game, we have the high-end Hummer. The first editions of those are right around, $110,000. It starts, though, the vehicle starts at $79,000, and then the Lyric starts at $59,000. And we're going to show the new Silverado EV at CES, which will be a pickup truck with a lot of innovative features. It's world class. We showed a teaser of the GMC Sierra EV in the last day or two, which will be the next truck. And, you know, after that, we're going to have some surprise showings of the Equinox at $30,000, right in the heart of the market, which is one of the biggest segments in the world. So, you know, the pipeline is absolutely full. We are getting now up and running with Ultium and that platform. And so it's huge volume and scale. And that's the strategy we have. So it's months, not weeks, years of difference. It's a pipeline of execution. And so we're so excited today to be shipping the first Ultium platform vehicles out of factory zero. And that's a pretty good feeling. And then BrightDrop, we have the first 5 units of our EV600, which is off of the Ultium platform, but for commercial vehicle. And that vehicle was the fastest vehicle done in General Motors history at 20 months. And there's the couriers at FedEx are actually sort of duking it out a little bit to see who can drive those first, because they're so excited. And the vehicle is really designed from the ground up with all of their requirements in mind. So it's a big deal.
Yeah, it certainly is, and it's going to be interesting to see those on the streets. Mark, the F-150 is going to have a head start, as you say, over the Silverado. What is it about the Silverado that you're so confident will allow you to catch up with the F-150?
Well, again, these are months here, not years. And so the cadence that we have, we're first. Okay, let's just be clear about that. We're first with Ultium today, with our BrightDrop van and Hummer. If you want to look at the competition, then you have to look at our cadence of what we're doing out of factory zero. But I am so confident when you see the design. Number one, the design. The design is like unlike any other pickup truck I've ever seen, because it is a ground up dedicated platform. There's things like a see-through roof. There's four-wheel steering. There's a whole bunch of other things that we're going to announce when we do it. And then we're going to show variants that, frankly, no one else has. So you're going to see a whole arsenal of Silverados and Sierras. And so it won't be just one truck. It'll be a whole portfolio. So that's very exciting for us. So I'm very, very happy and excited and confident.
So Mark, we're all looking forward to that Silverado at CES. At the same time, I want to come back to something you mentioned, the Equinox, and not just the Sierra, but the Equinox. Maybe something in the 30,000 range. You say you're going to give us a tease on that. When would that be available, do you believe, to be on the street? We know with the Silverado we're looking at 2023, I believe.
Right. It is. I can't ruin this for our team, because I'm getting a lot of trouble. But it's closer than what you think. Okay. And again, these are sort of the launch and activations of Ultium globally, but also in the United States market, obviously, but also in high volume with Equinox and things like Blazers. So you'll see those. Keep your eyes focused on CES, and you might learn a little bit more about that, David.
Let's hope CES goes ahead, because obviously a lot of events at the moment getting cancelled. We're dealing with Delta where you are. Omicron is coming. We're still trying to factor in what's happening with the chip story. Mark, can you give us a sit rep on what is happening inside the plants right now? Where are the bottlenecks? Where are the struggles? Where are you fixing things? What has still got to be fixed?
Well, I'll give you an example, Guy. You mentioned a few of the challenges we have, but we also have a Corvette plant in Kentucky. And as we all know, the tragedies that happened throughout, the storms that hit tornado-wise, some of these plants were in some of those places. And, we've got great people, and we've got great employees that are, fixing those challenges, as well as the communities around them. So we've deployed, quite a few people there to help the people in those communities. So, that's one set of challenges. The other set of challenges, I would say, is keeping the protocol in place that we had during, the heart of the pandemic, when we kind of wrote the book on when we switched to ventilator making and PPE making. A lot of those plants were switched to that protocol that we wrote the book on for how people work safely in our plants is still in place. And so, unfortunately, we have all that in place, but people have done such a good job. I can really say that, things happening inside our plants around the pandemic are few and far between because of the diligence of our employees and our protocol. So it's not a bad story, but it's very challenging for everybody.
Mark, we can't let you go without talking about microchips. It's just the story for the auto industry.
Sure.
2 questions. One is, when are you going to be past the worst of it for GM? And second, in the long term, will we ever get to a world where we make enough in the United States of America to supply what you need?
That's a great question, David. On the chip piece of this, you may have seen we have moved to partner with probably 8 of our suppliers, key suppliers on chips. And in that effort, we are consolidating the amount of chip families to 3. And so our future car designs will really have 3 families of those chips that can be spread across lots of our supply base in high volume. That's very key for us. And on bringing that into the United States, we have to have a more diversified supply chain of chips. And so I think you're seeing big initiatives around that, both on a federal government basis.
Yep.
And that's been talked about, but also inside the industry, where we have to really look at what each other's doing and get that here and get it as close to where we make things as we can. So I think there's a lot of that going on. So I think that's a good thing. When does it ease? And I've said this publicly a couple of times where it'll stabilize before we get the volume that everybody wants.
Mark, I'm going to have to jump in there. We're running out of time. Mark Royce, the GM president, David Weston. Gentlemen, thank you very much. This has been